Hello guys, welcome to Mind Money Muscle YouTube channel. Today we are discussing about Indian stock market and we seen the market is falling from past few weeks and there are some global uncertainties like India-US relations and some internal issues like corruption in terms of roads, government exams. There are several uncertainties. Many of the investors, especially retail investors, are thinking about whether it is the right time to invest. Is Indian market have potential to grow? So come on guys, I am going to answer all these questions in this video with the proper data. You guys evaluate the data, then you can think about investing in the market. Most of the retail investors might thinking at this moment whether to invest in the market or not because of the rate of corruption in India. And okay, let's get into the content. Indian stock market opportunities, risk, and future trends. Is it a gold mine or a bubble? Let's discuss about it. I hope I hope you guys know about this gold mine or bubble. Bubble may burst sometime. Gold mine may give you high returns. In that prospect, they told. And today's agenda is market dynamics, key opportunities, potential risk, future outlook, investor playbook. Let's get into the market overview, a dynamic landscape. Nifty 50 and Sensex at all-time highs with a periodic corrections. And retail investors, Zerodha Groww, surged democratizing access. India's robust economic growth fuels market optimism. FI is cautious, DIs provide strong market support. Okay, all these are seems like a technical terms. I will explain you in a very easy way so anybody can understand. See, Nifty 50 and Sensex, we know these are indexes. They are at all-time high. Means few weeks back it was in the all-time high and slowly little corrections are there. Corrections are good. Try to understand. If market is falling, means in market when it falls, it called as a correction. Means if it goes to the high valuation, so that high valuation is the really market performing in that valuation or not. If not, it will correct. In a similar way, once market reaches at the top, so it will take a some small correction, then it will take another high, small correction. So this is the market tendency to go high, correct a bit, then go high. So every time it takes some all time high and some small correction. We can call it as a profit booking also. And retail investors. So retail investors are us. We are the retail investors. In come after COVID, before COVID. Before COVID, the number of retail investors are limited. But after COVID, there is a huge surge in retail investors. Actually, it is a positive sign because people have more, means it represents how well people are educated, means how much financial knowledge they have, financial awareness they have. It represents about the retail investors. So if retail investors are increasing, it means that market getting more money from the people. So as more money get into the market, so that money utilized by the companies to more expand. So if a company expand more, may increase the profit. So it will improve the whole economy of the country. So it is good. India's robust economic growth fuels market optimism. Yeah, seems like we recently reached fourth largest economy, and our government also proposed a concept theme like we are going to become third largest economy by beating this Germany. There are some political debates. We are not getting into those debates, but the fact is fact. We are a fourth largest economy and we are going to bypass Germany and we are going to become the third largest economy after US and China. FIs are cautious, they are always, and DIs will providing strong market support because DIs means domestic institutional investors, most of the mutual funds. Just the reason is financial awareness among the retail investors. They are people who don't know about the stock market, who don't know much about investing and all. They blindly put their money in the mutual funds, and mutual funds invest in the market in the terms of DIs. So this is also good thing. So in the market overall, it is in a good way. Overview is good. Let's get into investor dynamics, retail boom and institutional shifts. See, as I told earlier, before COVID and after COVID. After COVID, there is a huge surge in the retail investors. It is around 75%. Means from the very beginning when the stock market is started, compared to that, there is a 75% growth in the retail investors. So it is really good to the market. Accounts with platforms like Zerodha and Groww have exploded, indicating broader market participation. And the thing is how much they are consistent or persistent, we can say, means if they just open the account, they are investing. So that is the another factor we need to consider, how much they are investing, how actively they are investing. If they are investing very actively, and if market there is a huge flow in liquidity. So these things I will explain in upcoming videos, how to see this liquidity in the market. So we can get to know, okay, this company market is going to grow. Otherwise is just show off. After some time market will correct, because it's a fake valuation. If valuation is worth, market stays high and keeps growing. But if the valuation is fake, the very moment when market observed it is a fake valuation, within a second it will fall to the lowest of the day or year. We can't control it. Almost market stays at its actual value. Sometimes it may go up or it may go down, but it will come back to the original place where it belongs to. So if we are understanding how if we are able to understand the market valuation properly, we are the king in the stock market, at least in the equity, not options or trading and all. In equity, you will be on the top, and 60% DIS and FIS balance. I'm not reading all this stuff. The only risky factor what I observed is this IPO frenzy and valuation concerns. The Indian market has witnessed a significant surge in initial public offerings. If you don't know about initial public offer, just make a comment in comment section. I will make a video about entire valuation, not just IPO, how valuation takes, how equity works, everything. I will make one video if you need it. Otherwise, no point of making a video. And while this indicates a vibrant market and strong investor appetite, it also raises questions about the sustainability of current valuations. Because even a small company, like recently we gone through one example, like a Hero Honda bikes. Some you have small showroom with only 5 bikes and 3 employees. They are able to get 100% subscription, means 100% high valuation. See, it is like overvaluation, and we know whoever took that price, after when the market realizes that, you did not even give you time to exit from that. You will be stuck there for a lifetime. So before applying for any IPO, go through the numbers. That is the financial education you need. It is not like every IPO is good. There are n number of at least thousands of companies listed in the market. Still, we are considering Nifty 50. So that is the importance of company performance and company background. Fundamentals you need to check before investing or before subscribing for IPO. Record number of IPOs, new companies entering the market at an unprecedented pace, because that is an opportunity for any company to raise money, because you guys are blindly investing in trying to subscribe any company. So that's why every company trying to utilize this opportunity. That's not bad from them. It is good if you learn about if you read about the company before investing. High subscription rate. This is the major problem. Many IPOs are heavily oversubscribed, sometimes by hundreds of times. See, so at least someone stuck over there with that valuation. Valuation of scrutiny. Are new listing priced fairly? Are they setting up post listing for corrections? The same thing I explained so far. After listing, it will correct. Correct will be a generally in the market, correction is normal. But in these cases, there will be a crash. It never give you a time, means it won't give you time to exit. That is the major point when it comes to the IPO. Otherwise, you check the fundamentals. In my previous videos, I have explained what are the basic fundamentals and right time to exit and right time to entry. All these things I made up good videos. And I also made another video. It's about how to use ChatGPT or artificial intelligence to read your stock. No need to put a lot of head into that. Just go, and the prompts also there you can use directly. Sector specific opportunities. This is the best way to list out your stock or investments. Technology and SaaS. Digital transformation, AI and cloud adoption drive immense growth potential. See, these are the digital transformation we are seeing, and in the world we have highest internet access, and everything we are trying to make e-governance, and everything we are going into digital because digital India, right? And AI also, everyone is using AI for content creation and all. Even I am using AI. This PPT I made by using AI. So these are the future. If you are able to predict the future and you are investing in the right things which are going to give you high returns in the future, you are rich in the future. Okay, you will get huge money. So this is future. This and the present also. Present you invest, it will give you high returns in the future. Renewable energy. See, renewable energy, government initiatives and climate goals are accelerating investments in green energy like solar, PM Surya Ghar. To understand whether government going to invest in a particular sector or not, whether to invest in that particular sector or not, it is easy. If government taxing, putting tax on some part of thing, government don't want that product to sell, and government investing on something means government want that to work. So that is the place you need to focus. If government is working on investing in solar or green energy like windmill, whatever, so you no need to just invest in government companies. You can invest in private companies also, like Adani, Reliance, whatever. Whoever entering in the renewable sector. Somehow Switzerland winds also good, but fundamentals are important. So the companies which are working on renewable energy, you can invest. That will be the future again. So we need to focus in the daily news whether government is investing in particular sector or government taxing on some particular sector. If government putting taxes, charges, never invest on those things. In always choose the companies where government led because it invests thousands of crores. It gives huge loans also to boost that particular sector. Healthcare and pharma. India is well known for healthcare and pharma. We all know. Rising health awareness, medical tourism, and R&D propel this defensive sector. See these things, world's largest vac manufacturers. Even during the COVID, we sent means we shown the strength in our pharma. So even US afraid to tax on this pharma product because they need our product. So one sector you can blindly invest is pharma and healthcare, and manufacturing and production linked intensive schemes, PLIs. As I said earlier, if government is giving production linked intensive schemes and supporting manufacturing in the name of make in India, made in India kind of things, so slowly we are improving our manufacturing capabilities and production facilities. Because earlier our economy, it is like first it will come to the agriculture, second it come to the manufacturing only, but it won't give high output. Mostly it is the tertiary IT services and all. We India known for IT services, but from that to now till today we are focusing more on manufacturing by giving production linked intensive schemes and all. So all these things shows that we are moving upwards and we are trying to grow. So where there is a will, there is a way. So our will is to grow. So our market may grow by basing this production linked intensive schemes, renewable energy, and our digital transformation. We are up to date with the technology and we are focusing on the right sectors. So there is a huge possibility that Indian market going to boom very soon. Navigating market risk. Of course, there are risks. So we need to understand how we are moving with the risk. Means you need to dance in the rain, to be frank. See, global volatility, it will be there. From past 5 years, we are seeing like a war between Russia and Ukraine, war between Iran and Israel, and Hamas, whatever, and India, Pakistan, this operation Sindur, everything we have seen. These are the global uncertainties. It will be there. So we need to observe during that global volatility or uncertainties how our markets are reacting, and over period of time if some kind of reaction is happened, if you find out it before that reaction, that is well and good. But if you are already in the loss, no need to afraid. Wait for some time. In the right time, you can invest. I mean, there are some other technique, averaging or tax harvesting. Different methods are there. You can utilize them. If you don't know about tax harvesting or average, this kind of techniques, comment, and I will make a separate video about that. Inflationary pressures. Rising inflation and interest rate hikes can dampen corporate earnings and consumer demand. See, inflation is a bad thing, but at the same time, inflation also good thing. So we don't need to worry about it. RBI will take care of that. Regulatory changes, new policies or tax reforms can introduce uncertainty for specific sectors. It is obvious. We can't comment on that because it is totally up to the government. And whatever the policies or tax structure will get, move according to that. Don't go against that. My suggestion. If government is taxing on some sectors, no need to go aggressively in that. Our government is making some policies to some sectors. Go to through those policies. No need to go against. Go with the flow. Valuation bubbles. There is valuation bubbles in the market. Means some companies, if you know about this, means to understand more about valuation bubbles, in my playlist there is something like pump and dump techniques and all. You can check that also how it works. The basic principle I have explained there. Otherwise, these valuation bubbles, if many people are continuously buying artificially, if someone increasing the valuation of that particular company, so it will bubble. During this Arshad Mehta time also, is getting some money from banks, and that money is infusing into the market. Due to that artificial demand, market there is a it created a bubble. Means it's growing. It reached at peaks, still it's growing. But the market actual valuation is not there. That's why when people get to know about this scam of Arshad Mehta, 3 days market was in negative mode. You can read about this. So that is the problem there we can understand now. So when valuation, if a particular stock is growing abnormally, try to learn when to exit. If market have the potential, go with the numbers. What is its market capitalization? How much profit it making? And what is the debt? And what is the shareholder pattern? How much promoters holding the share? So these are the basic thing you can check. Future trends, long-term growth catalyst. Several underlying trends suggest sustained growth for the Indian stock market in the coming decade. Demographic dividend. A young growing workforce drives consumption and productivity. Digital economy expansion. Increasing internet penetration and digital payments fuel tech growth. Infrastructure boom. Massive government spending on roads, ports, and smart cities. Make in India initiative focus on domestic production, reduces import dependency, and boosts export. See, even the good several trends, underlying trends, and some agencies suggesting that long-term growth is possible. Digital economy expansion. We already discussed about digital economy expansion. There is no doubt about it. Infrastructure boom. Yeah, government focusing more on infrastructure boom, infrastructure investments like roads, bridges, and companies and all. Moving massive government spending on roads, ports, and smart cities. Make in India initiative, we have already seen we are the top manufacturer of mobiles and all. There are some other sectors also where we are performing better in the name of Make in India. That is good. So overall, these are the things suggesting that for long-term investment. Investor playbook, smart strategies. Diversify your portfolio. See, one old saying like, don't put all your eggs in one basket. Don't put all your money in one sector, like a defense sector, like only IT sector, no, otherwise only FMCG. Instead of that, distribute your money. Whatever, if you are getting 5,000 to invest, you don't need to exactly distribute 1,000 for each sector. Digital as well as a green energy. In the 5,000, put around 40% in IT, 30% in green energy, 20% in some risky stocks, like that. You can distribute, diversify the portfolio. for sector wise, not one sector, different companies. Sector wise portfolio will be more beneficial. If IT fall, manufacturing will grow. If everything fall, FMCG grow, something will grow. Not it is not like every sector will fall. That is rare case. They call it as a recession. And invest for long term. See, compounding works wonders. This person, we all know about the Warren Buffett. He got rich at the age of 60. Compounding works for him. He worked for him. But in my opinion, getting rich at the age of 60 is not a good thing. To be frank, you need to be rich as soon as possible. Then only you can enjoy your life. This much I have understood. So understand the how compounding will help you, as well as short-term speculation also needed in the present scenario. Maybe in his time, long-term compounding may given him good results. Now market is like fluctuating. Now market fluctuating like anything. You are invested at some value. Let's say Tata Motors, you invested around 360. You took for the long term. Within 1 or 2 years, it reached more than 1000 or 2000 from 350 to 2000, and you didn't exit there. After 10 or 20 years, it came back again to 360. So what is the point of investing for long term? So it is very important, right time to exit, right time to entry. So blindly putting it for long term, observe the market, understand. If you don't know what to see, there are n number of sources you can learn from them. And continuous learning, the same I was saying, continuous learning is needed about the market, about the stocks you have invested, and about the international relations, society, everything, trends, sentiments. These kind of things also plays a important role in the market growth. Systematic investment plans. To be frank, these SIPs are a huge trap for retail investors like us, because what they are planning, you invest, even they are telling you to invest even 50 rupees per month. So it won't give you anything, but it is for their gain. Big institutes, 50, 50, 50. Even 50,000 people put 50 rupees per month. It will be a huge investment for a bigger companies. Out of that, they will give you very less amount. But to get that compounding effect as a individual, put SIP for a stock. Yeah. Irrespective of high and lows, put SIP for a particular stock which is very good, sound in the fundamentals and all. So that will give you compounding results. That will give you good returns. It may be a multi-bagger in the later. And I'm sure compared to any company's mutual funds returns, these returns will be good if you choose the right stock. Okay, Indian stock market, a land of opportunity with a prudent navigation. Thank you for your time.